Chapter 2. International Commercial Banking. In this chapter, we will cover the introduction to international commercial banking. Functions of international commercial banks. Facilities offered by international commercial banks. The effects of international foreign commercial banks, and international retail banking, branchless banking, and private banking. At the end of this chapter, you should be able to identify the functions of international commercial banking. Explain the facilities offered by international commercial banking. Describe the effects of international commercial banking, and differentiate between the international retail banking, branchless banking, and private banking. Introduction to international commercial banking. International commercial banking is the intermediaries that move money from the capital markets to businesses and institutions. Banks get their money from deposits, checks, service fees, issuing certificates and notes, joint ventures, foreign exchange, and loan. Commercial banking specialize in transferring funds and debts, and translation of business practices across the world. The global nature of commercial banking as the main player in the financial market makes the distribution of valuable economic and business information among customers possible, and they also serve as a worldwide indicator of economic health. There are 5 functions of international commercial banks. First, provide facilities for saving through savings, current and fixed deposit account, and other financial instruments. Second, provide facilities to effect payments on behalf of its customers. Third, providing credit, loan, and advance facilities to both individual borrowers and corporate customers. Fourth, providing financing to the government through the purchase of government securities and treasury bills. And fifth, providing a wide range of other banking services such as remittances, foreign exchange transactions, and the financing both domestic and international trade. There are 4 types of facilities offered by international commercial banking. First, trade finance. Under trade finance, there is a type of negotiable instrument called letter of credit. Second, deposit facilities. There are 5 types of deposit facilities. First, demand deposit. Second, checking account. Third, saving deposits. Fourth, time deposits. And fifth, negotiable certificate of deposit. Third type of facilities offered by international commercial banking is foreign exchange or currency market. And lastly, fourth, corporate finance. Under the corporate finance, there are 4 types of debt instruments. First is syndicated loan. Second, euro currency market. Third, eurobond issuance. And fourth, miscellaneous banking services. Under the trade finance, commercial banks that do international business are also called investment banks because they finance the international trade of export and import by issuing the letter of credit. A letter of credit indicates the customer has deposited the full amount due on an order with a company located in a different country. The seller company can then feel assured of being paid if it ships goods to its offshore customer. Letter of credit transaction starts once the importer and exporter agree to conduct business. The exporter will request a letter of credit to guarantee payment. The importer applies to his bank for a letter of credit in favor of the exporter for a fee. The U.S. bank, as the importer's bank, approves the credit risk of the importer, then they issue and forward the letter of credit to the exporter. The exporter ships the goods to the importer once received the letter of credit. Next step is the exporter presents foreign bank or advising bank with a time draft and the required documents on the U.S. bank to be processed for payment. Then, foreign bank sends immediate payment to the exporter. After the payment is sent, foreign bank returns the time draft to the U.S. bank. And lastly, the issuing bank accepts the draft and decides whether to hold or sell it. When the draft matures, the holder demands payment from the importer. The second type of facilities offered by international commercial banking is deposit facilities. Foreign commercial banks in Malaysia are allowed to offer its services to residents and non-residents, individual and organizations. The first type of deposit facilities is demand deposit. Demand deposit is a checking account in which the owner is entitled to receive his or her funds on demand, and to write checks on the account which transfers legal ownership of funds to others. The second type of deposit facility is checking account, which serves as a basic medium of exchange in the economy, amounting for about half of the total money supply. Third, for the savings deposits, the passbook had to be presented, and transaction recorded when funds were deposited and withdrawn. But, nowadays depositors do most of their savings transactions electronically, and receive quarterly statements from bank. Next type of deposit facilities offered by international commercial banking is time deposits. Under this type of deposit, funds cannot be transferred to another party by a written check until the maturity date. The last type of deposit is negotiable certificate of deposit. It is the unsecured liabilities of commercial banks, and commonly denominated in a very large number or amount, which issued to corporate customers or wealthy individuals. This deposit has a fixed maturity date. However, it is negotiable, which means it can be redeemed at any time in the secondary market, without loss of deposit funds. Meanwhile, under the Forex or foreign exchange, banks do the exchange and foreign currency trading. Forex is considered as the largest and most liquid market worldwide. Its average daily trading volume exceeds $5 trillion. The main participants in Forex are larger international banks. Central bank plays a major role in controlling every aspect of money flow, such as inflation and deflation, money demand and supply, interest rate, and etc. Currency market also assists in the implementation of risk management, under hedging exchange rate risk. The last type of deposit facility is corporate finance. Corporate finance is the borrowing or financings made to cover the purchases of production inputs, such as purchasing of raw materials, machinery parts, inventory parts, and payroll. There are four types of loans and securities instruments under the corporate finance. First, euro currency market, or euro markets. Second, syndicated loan. Third, Eurobonds issuance. Fourth, miscellaneous banking services. Euro currency market or euro markets are the markets for borrowing and lending currencies outside their countries of origin. For instance, Malaysia can borrow the US dollar from China, and do not need to borrow directly from the US country, because China can provide the US dollar financing with lower interest rate. Meanwhile, syndicated loan is the credit facility offered simultaneously by a number of banks from more than one countries. The banks sign the same loan agreement, and stand equally in the right of repayment. For the Eurobonds issuance, it is a debt instrument that is denominated in a currency other than the home currency of the country, or market in which it is issued. Other than these three debt facilities, international commercial banks also provide a miscellaneous banking services under the corporate finance facility, such as corporate checking accounts, currency-specific credit cards, and lock boxes. The international banks also provide consultancy and advisory on managing risk and hedging strategies, interest rate and currency swap financing, and international cash management services. The international foreign commercial banks could give the positive and negative impacts to the banking sector. Among the positive impacts are it could strengthen the competition, and increase the efficiency among the banks. The rapid growth of the international banking network has enabled banks to easily access the production factors, such as capital, technological capabilities, skilled and knowledgeable workers, and the international network to facilitate banking activities. Other than that, international foreign commercial banks also could give the positive impacts in terms of managerial and marketing knowledge. Knowledge advantage. Information services. Prestige, image, and reputation. Regulatory advantage. Defensive strategy advantage. Transaction costs reduction. Business growth. The advantage of risk sharing. Diversity of choice, and high liquidity. Meanwhile, for the negative impacts, it can be highlighted in regards to the international transactions such as information asymmetry. Information asymmetry means the imbalance in information distribution among different parties. Meanwhile, moral hazard and rationing can happen when the sovereign forces the borrower to extend more credit than is optimal. For the free rider problem, it is the act of refusing to accept the restructuring offered. Other than that, the negative impact of relying much on equity than deposits could risk losing control to the company. And lastly, Political instability, such as the changes in international regulation for certain countries, could give the bad impact on organizations. International retail banking, branchless banking, and private banking. There are 5 types of international banking offices. First is correspondent bank, second, representative office, third, foreign bank, fourth, subsidiary and affiliate bank, and fifth, offshore banking centers. The correspondent bank can be considered as the lowest possible of banking exposure to the foreign market. It provides the trade-related and forex services for its multinational corporations' customers in the foreign market. This type of international banking office does not need the physical presence in the foreign market. Normally, smaller foreign banks that want to do business in other country will enter into a correspondent relationship with a large bank abroad, and they need to pay for a fee. The representative office has a physical presence in the foreign market, but with a limited function. This type of international banking office is not allowed to offer traditional banking services. However, they assist their multinational corporations' clients with information such as the local business practices, economics information, credit evaluation of customers, etc. There is no traditional credit services provided by the representative office. The office looks for foreign market opportunities and serves as a liaison between parent banks and clients. This type of international banking office is suitable and useful if the banks want to explore the new market in an emerging market, due to its low budget, and can be easily closed down. Foreign branches operate like a local bank, but it is legally part of the parent bank, and not a separate entity. This bank acts as a legal, functional, and marketing arm for the head office. This international banking office is subject to both home and foreign countries' banking regulations. They are basically more independent in making decisions, as compared to a representative office. There are some reasons for a bank to establish a foreign branch. First, to offer a more extensive range of services, such as faster check clearing, and larger loans. Second, to take advantage of situations not subject to local reserve requirements. Third, to compete with host country banks at the local level, and lastly, to internationalizing bank operations. Subsidiary bank is a locally incorporated bank, either wholly owned, or owned in major part by a foreign parent. Affiliate bank is partially owned, but not controlled by its foreign parent. This bank engages in full banking activities as permitted by host country regulations. They are operated under the banking laws of the country in which they are incorporated, and they are allowed to underwrite securities. Major disadvantages of subsidiary and affiliate banks is that it must be separately capitalized from its parent. Thus, it requires a high amount of startup investment. Offshore banking centers is related to a country with its banking system is organized to permit external accounts, which beyond the normal scope of local economic activity. The host country usually grants complete freedom from its governmental banking regulations. Offshore banking centers operate as branches or subsidiaries of the parent bank. The primary activities of this bank is to seek deposits and grant loans in currencies other than the currency of the host or local government. Among the features of offshore banking centers are first, they are unregulated institutions, which comprise of low reserve requirements, and no insurance protection for deposits. They also are not subject to interest rate ceilings. Offshore banking centers can take advantage of low tax locations. This type of international banking office engaged with a high degree of competitiveness, and they got no pressure from the domestic government. Some reasons for banks to open their offshore banks are because low or no taxes, services provided for non-resident clients, few or no forex controls, and legal regime that upholds bank secrecy. Now let's discuss on the last part of this chapter. Types of banking distribution strategies. There are few types of banking distribution strategies such as branchless banking, private banking, and retail banking. Branchless banking is a distribution channel strategy used for delivering financial services without relying on bank branches. For examples, the internet, automated teller machines, point-of-sale devices, electronic funds transfer at point-of-sale devices, and mobile phone. The advantages of mobile phone branchless banking are, it is very mobile, which can be used anywhere and anytime. Its operation is up to 24 hours a day. It is require only a small fees for agents. Mobile phone branchless banking has enabled customers to withdraw or deposit a small amount of money, and customers no need for a bank account. It is almost paperless, which can save the environment. Mobile phone branchless banking can generate low income for thousands of agents. This type of banking require a very small bank overhead costs. It is suitable for a low-income people, and people with low literacy, and this type of banking distribution strategies could reduce the transportation costs and time. Private banking provides banking, investment, acquisition, and other financial services to private individuals, who enjoy high levels of income, or invest a sizable amount of assets. The term private refers to customer service, which rendered on a more personal basis than in mass-market retail banking, usually via dedicated bank advisors. Private banking forms an important, high-level, and more exclusive form of wealth management to a wealthy group. Private banking largely consists of banking services like deposit taking and payments, discretionary asset management, brokerage, limited tax advisory services, and some basic concierge-type services, which are offered by a single designated relationship manager. Traditionally, private banks were linked to any specific families for several generations. Retail banking is also termed as personal banking services. It is when a bank performs transactions directly with end customers, rather than large corporations or business entities or other banks. The retail banking term is generally used to distinguish these banking services from investment banking, commercial banking, or wholesale banking, which are more to macro banking. It refers to a department or division that deals with retail customers, or micro-banking. Among the products and services offered by the retail banking are transactional accounts, current accounts, savings accounts, debit cards, ATM cards, credit cards, traveler's checks, mortgage, home equity loan, personal loan, certificates of deposits, and term deposits. We have completed Chapter 2. Please read the textbook for detailed explanation. Thank you.